Attention gold traders and enthusiasts, listen up. Gold is currently hovering around the $5,000 mark in 2026, and it's fair to say that it's teetering on the edge of a cliff. The momentum is noticeably waning, and every attempt to breach the $5,415 resistance has been met with fierce selling. So the question on everyone's lips is whether gold is about to stage a dramatic bounce.
Stay tuned, because we are about to break down the charts and the factors that may determine gold's fate in the coming days.
We're going to start with the current gold structure and momentum shift. First question. What are the current technical indicators telling us about the strength of the gold market?
So gold has been stuck in this narrowing range between roughly $4,966 and $5,030 for a while now, and recently it has been slowly drifting lower. Each attempt to rally is weaker than the one before, making lower highs.
Not looking too bullish at the moment.
No, I mean, the moving averages are flattening. The shorter term ones are about to cross the low. The RSI is hovering around 50. The MACD has been in a bearish configuration for a while. And the fact that we have formed a bear flag and broken a rising wedge, all of this suggests that the path of least resistance is down, until proven otherwise.
What are the fundamental factors that have been contributing to the recent weakness in gold prices?
So one of the biggest drivers has been the shift in expectations for interest rates. The market had been betting on multiple rate cuts from the Fed in 2026, but those bets have been steadily scaled back, and now the consensus is for only one cut, or even none at all.
So that's making gold less attractive to hold?
Exactly. Higher rates mean a higher opportunity cost for holding gold. And on top of that, the dollar has been bouncing back, and the fears of inflation have been replaced by a more balanced view. Add to that the fact that central banks have been buying less, and that investors are taking profits, and you have a recipe for a correction.
So what do the current price patterns and recent breakouts suggest about the near-term direction of gold prices?
So we have seen a couple of false starts to the upside, where the rallies have fizzled out below that $5,030 to $5,050 resistance. And then once we broke below $5,000, there was a bit of an acceleration to the downside.
Here are the potential levels to watch on the downside?
Immediate support is around $4,966, but if that goes, we could quickly fall to $4,930, and then even $4,842 before we get to the more significant $4,592 zone, where the 100-day moving average sits. So bears are in control until we can reclaim the $50.30 to $5,050 area.
Okay, so the next thing we want to talk about is the key resistance and selling pressure. So the big question here is, why is there such strong selling pressure around the $5,415 level for gold?
So that $54.15 area is a significant level because it was the all-time intraday high that was set in March of 2026 when the market spiked up due to the US-Iran tensions. But that rally was short-lived and the price quickly reversed, leaving behind a lot of sellers who were eager to get out at that price.
So it's like a magnet for sellers.
Exactly. Plus, there was a lot of profit taken. The gold price had run up so much from the lows, and then there were also the algorithmic traders and the stop losses that were triggered. So when the geopolitical fears subsided, there was no longer any reason for the safe haven buyers to keep buying, and the stronger dollar and the higher bond yields made gold less attractive. So the selling intensified.
So how does the current selling pressure around $5,415 impact the short-term outlook for gold prices?
So the repeated failure to hold above that level creates a ceiling for the price. So unless there is a significant shift in the fundamentals, gold is likely to remain in a sideways to downward drift.
So what does that mean for traders and investors?
In the near term, it will be important to watch the reaction to the key levels below 5,000. It could get ugly, but above 5,230 might bring in some more buyers. But ultimately, until the $54.15 resistance is decisively taken out, the bears have the upper hand.
So what are the main factors that could cause gold
To either break out above $5,415 or remain stuck in this downtrend. So the current downtrend will likely persist until the bulls can muster enough conviction to overcome the formidable supply zone between $5,300 and $5,415. Until then, rallies may be seen as opportunities to sell.
So what could potentially trigger a shift in sentiment?
Only a significant change in the Fed's stance, a weaker dollar, a resurgence of safe haven demand, or a renewed bout of inflation fears could really propel gold above the $5,415. Otherwise, without a catalyst, the bears will likely remain in control.
Okay, so let's move on to the next part of our discussion. And we're going to focus on what might happen at the $5,000 level. So the question is, if gold reaches $5,000, what are the likely scenarios that could unfold?
So the 5,000 level is extremely significant. It's not just a round number, it's also where the bulls have repeatedly defended and where the bears have repeatedly tried to break. So if we get to 5,000, we could see a few things happen.
Volatility could really pick up.
Exactly. The first scenario is that the bulls and the bears are going to battle it out, and neither side is going to give an inch. And we're going to be stuck in a range for a while until one side wins. And the second scenario is the Fed could come out and make a dovish statement, and that could send gold back up. Or, alternatively, if the bears get a strong fundamental catalyst, they could push gold below 5,000 and potentially trigger a wave of selling.
Okay, so let's say we get to $5,000. What are the odds of each of the different scenarios playing out?
Based on current conditions, the most likely scenario is that we're going to see a lot of back and forth in and around the 5,000 level for a while. Maybe even a slight bounce, as long as the fundamentals don't shift.
So choppy waters ahead.
Yep. A sustained break below 5,000 requires a catalyst that's strong enough to overpower the dip buyers. So that's less likely, maybe a 20% chance. And then a breakout to the upside is even less likely, maybe a 10% chance. The remaining 70% of the time, we're going to be range-bound with heightened volatility.
So what does all of this mean for traders and investors who are trying to navigate the gold market right now?
It means that 5,000 is a psychological and technical battleground, and it's going to take a significant shift in fundamentals to decisively break out of this range. Until then, expect lots of volatility, expect false breaks, and expect a lot of noise. So the smartest approach would be to proceed with caution.
Exactly.
Be nimble, manage your risk, be ready to adjust your positions if one of the more extreme scenarios plays out. But for the majority of the time, gold is likely to trade in a wide range, and the current consolidation is more of a pause in the ongoing bull market than a reversal.
So what do you think? Will the $5,000 level hold, or are we in for a breakout? Let us know in the comments below.
We have reached the end of the road. For today, remember to stay sharp and always do your own research. Until next time, happy trading.